In this video, we're going to discuss distribution days, what they are, and why we keep track of them. A distribution day occurs when either the NASDAQ or S&P 500 declines at least 0.20% on heavier volume than the prior session. Why is this important? Well, a distribution day lets us know that large institutional investors may be selling or distributing their stocks. Hence, distribution days are counted over the course of an uptrend to help us gauge potential trouble on the horizon. Occasional distribution days over the course of an uptrend are normal. It's when we start to see clusters of distribution days begin to pile up over a period of a week or two that raises the warning flag. Remember, professional money managers do their best to sell or distribute their stocks as the market is on the way up. Fortunately, Bill figured out a way to spot when the pros are selling their shares while the market is still rising, which lets us know that it's time to be careful before potential trouble begins. It's important to keep in mind that learning how to properly interpret price volume action is key when counting and interpreting distribution days. So let's go ahead and take a look at some examples. So here's an example of the NASDAQ composite. You can see right here, this is the beginning of last year's uptrend. Here is the April 6th, 2020 follow-through day. So what we're looking at here is the distribution days that occurred prior to the correction just before this follow-through day. So going back is referred to as a stalling or churning day, otherwise known or referred to as subtle distribution. Even though this day right here does not qualify for distribution by the strict definition because we didn't close down at least 0.2%, because we were at an all-time high and ultimately closed near the lows of the range as volume picked up. That is your textbook definition of stalling or churning, and hence we count that as a distribution day, even though it's subtle distribution. The following distribution day here is simple. This was down over 0.2%, volume picked up. So here we've got two distribution days. As we go along here, we don't pick up another distribution day for almost a couple of weeks. There's nothing magical here. We're down over 0.2%. It's hard to see, but trust me, I've looked and looked again. Volume's a tad bigger here, so this counts as an official distribution day. And then we start to see it cluster up a little bit in this area here. It's like we went from an all-time high. This is a big negative reversal, closing on the lows, volume picks up. We've got an outside day down or bearish engulfing pattern, which is at least short-term bearish. And you'll see we've got marked here, even though this doesn't qualify as an official distribution day. And why is because distribution was a tad lighter, although you've got a big gap down and close below some short-term moving averages here. Not much of a rally off the low, so even though volume did not increase, it was well above average. So that's, even though it's not officially in a distribution day, that's not a good day. So that's worth noting. That's negative action. Here is our next one in this little cluster here, and you'll see even though we closed up on the day, we are closed well off the highs, lower third of the range, and we barely made price progress here. This is where you don't want to be fooled, and it's even more subtle because you'll see the price closes up on the day and volume is higher. However, this is, when we were discussing the rules, why you've got to really pay attention to price volume and how you're interpreting things here. It's very easy before you take a close look to possibly count that as a day of accumulation or a positive day, and in fact it's little price progress to the upside with a pickup in volume. So clear churning or stalling action there. Now we're coming into another day like we saw back here, off the highs of the day, outside day down or bearish engulfing pattern, close back on the lows, volume picks up to well above average. So as we move along here and come along to our next day of distribution, we're looking at another day of stalling or churning action like we just discussed here. And then as we can see, here's our top. Everything's looking, just fine, but Here we get hammered with some distribution starts again. We can see here we close well down to over 0.2%. Volume picks up, and now volume really starts to pick up. If you just look back over the prior weeks, maybe a couple of months there, you'll see this is the biggest volume. You're right here. This is the biggest volume we're seeing in quite some time, and then it gets even bigger as you break below its 50 and 65. So the idea here, and this isn't a perfect black and white methodology or technique where so many distribution days and so many days says time to sell all your stocks. I would say there was a point back in the late 90s where it was sort of magical in that respect. Once you saw distribution start to creep up, maybe 3 or 4 days within a week to 2 weeks, and leading stocks started to weaken, you were typically in great shape if you moved out of the way quickly. And now it's become, I would say, less useful. When you're seeing the distribution days start to appear like this, the most important thing to look for is the health and breadth of your leadership. How is it acting? Is it acting healthy while the market is not? Are you seeing healthy rotation such that if the market does pull back, we're going to get support from some other groups where we're seeing some clear accumulation? Or are we seeing, the majority of whatever was leading the market begin to pick up distributive action and look like it's rolling over along with the market? So that's always going to be your key, whether you're looking at follow-through days or clusters of distribution. The real question you always want to ask yourself is, how is the health and breadth of market leadership? So let's go ahead and take a look at our next example. Here we're looking at the S&P 500 over that same time period. This is the follow-through day last year at the beginning of April. And so again, we're looking at the distribution that occurred on the way up just prior to this correction last year before the big rally got underway. So again, we're going back about 5 weeks here, which is the relevant time frame for distribution. Here we've just got a down day of 0.2%. We did close mid-range, so here it's not a severe day of distribution, although it's not screaming accumulation either. So it's worth marking down. It meets the textbook definition of being down over 0.2% or more on higher volume than the prior day. So we continue to move along and hit our next distribution day again. This is reversal on, close on lows. We pick up distribution after making highs on big volume the day before. We take a look here. We've got another ugly day of price action, although volume declines. So that takes some of the severity out of the way there. If volume would have picked up higher than this day here, that would have been another day of churning or stalling, or it would have been the first and only churning or stalling day. However, volume didn't pick up, so that does not matter. As we continue along here now, we're starting to see that action like we were looking at on the NASDAQ, where we go from highs to closing on near lows of the day, in the bottom third of its range, below its 10-day moving average, volume picking up, followed again. In this particular case, when we gap down below further moving averages on the NASDAQ, we didn't pick up volume, so it didn't count as distribution, although we marked it as a bad day. In this particular scenario, the S&P 500, when what we're looking at here is NYSE volume, when we compare it to the S&P 500 price, volume picks up again on this big gap down. So these are two pretty big distribution days. Just another couple of days later, we pick up another day of distribution. You'll see here we closed more or less flat, certainly not down the minimum of 0.20%. However, this was another stalling or churning day here where we reversed off highs, closed on lows, volume picked up, and even though we didn't close down the minimum of 0.2%, this is considered subtle distribution. So again, we go 2 days later, we've got another big down day all the way to its 50-day moving average on significantly heavier volume than we've seen going back quite some time here. So, at this point, with this big cluster, you're keeping a close eye on what leadership is doing at this point. Are you seeing any clues that the current rally could continue based on the health and breadth of leadership, What does rotation look like? Does it look like money's coming out of one and into another where there's plenty of stocks, in the earlier stages of their overall cycle that money could move into and keep the rally going at logical support? Or are you looking at a bunch of leadership that's looking tired, that's come a long ways and is starting to look a little toppy and roll over with the indexes? So we get a little reprieve here for a few weeks. And in these particular cases here, even where we have the blue lines, these are the opposite of churning or stalling days. So in these cases where we actually do close down over 0.2% on heavier volume, because we close well off the lows of the day, and if you were to extend this line to make it fair to the prior day's close, this is well off its lows and more of a subtle accumulation day than distribution. You can see here we make highs on lighter volume. And again, even though we've got this big sell-off, we bounce off lows, close back up above its 10-day moving average. We're down over 0.2% here. Volume does pick up, so yes, it meets the textbook definition of distribution. However, this is a subtle accumulation day. You close top third of the range, volume picks up. That is not even subtle to me. That's just a clear day of accumulation. But I always mark these because if you follow Investors Business Daily, they always count this as a distribution day, which I don't really understand. But nevertheless, moving along the next day, we get a clear distribution day. Volume picks up again clearly. We're down over 0.2%. And here, if your leading stocks in the indexes haven't had you move well out of the market and reduce exposure by this point, this gap down and immediate undercut of the low is letting you know there's a problem here. And by this point, my guess is leadership has certainly let you know. In most cases, it's going to let you know as the distribution is happening, and give you a chance to really protect yourself before the market starts doing this. Even if you waited to the last minute and waited for the 65 exponential moving average undercut here, even if you sold on the undercut, you're still saving yourself a ton of pain and profits between here and the ultimate lows. So that is why we count distribution days and how we use them to help keep us out of potential trouble on the horizon.